There's the closing bell on Wall Street. Now it is market domination overtime. Jared Blicker going to be along to get us the details from today's action. I'm going to start with the major averages here and a surprise finish here after a pretty surprising session all told. So basically, let's recap. We had, of course, the Mexico and Canada tariffs of 25% go into effect at midnight. China tariffs of a total of 20% that now have been put into effect by this administration. A lot of investor talk that they thought it was just sort of bluffing or a negotiating tactic. Now a lot of questions about how long those tariffs might stay in place. All of this equaled a good amount of selling at the open. Then we saw stocks kind of climb back from those levels. In the case of the S&P and the Nasdaq, even climbing into the green, and then a late finish downward here. So we'll see what happens. We, of course, have President Trump speaking before a joint session of Congress tonight. Presumably, he will be speaking about tariffs, among other things, so we'll be listening to that closely. The S&P 500 finishing lower by 1.25% here today. Again, saw that little bit of a peek into the green within the last hour of trading. And the Nasdaq Composite still doing the best of the three. We did see some rotation back into some of the beat-up tech names that have been falling so much recently. But again, that was short-lived, finishing down by about 1/3%. Jared, what happened here in the last half hour?
I said at the top of the 3 p.m. things could be worse, and I guess they got a little bit worse. So I want to take a look at volatility here. The VIX, I think, is instructive. We peaked earlier just before the market opened at 9 a.m., and we kind of drifted down all day. Then we had a little bit of a spike at the end. Nothing to write home about, but in the context of the 3-month chart, you can see we're getting higher there. This is that mid-December meeting, that hawkish meeting that caused a bit more volatility at the time. Also, another quick look at the MOVE index, that is bond market volatility. That is elevated. That is the highest point in the last 3 months. And let's get to the sector action. When I was looking at the sector action 1 hour ago, tech was the only sector in the green, but it was up by about 1%. It ended the day down by about 5 basis points. So you can see that is what happened over the last hour. So not the best ending to this very auspicious day. Financials down 3.5%. I would note that only a few days ago, it was hitting record highs. I think Monday morning, yesterday morning, it opened up at a record high. It is down substantially since then. And let's take a look at our leaders. We do have some green here. China is up 2.64%, at least in internet stocks. That's KWeb that I'm looking at in the upper left. Solar stocks doing well. Bitcoin up a little bit today. Emerging markets, okay. Chip stocks were kind of a bright spot earlier, and you can see we're closing the day with some gains. Not as big a gains as we had earlier in the day. NVIDIA had a 2-handle, but in Intel, one of the outliers here to the downside, that was down 6%. I'll leave you on the ARK Innovation Fund. That was a bright spot in terms of some of the smaller names. Still seeing those, but Tesla, the big guy, down 4% today. Josh?
All right, thank you, Jared. For more on today's sell-off, let's welcome in now Brad Klapmeyer, Macquarie Asset Management Senior Portfolio Manager of the Large Cap Growth Team. Brad, it's good to see you. So let's talk about these tariffs, obviously introducing uncertainty and volatility. It's risk-off in the markets. Brad, I'm just curious how, if at all, this is all just impacting your view of the market, where we are and where you think we're headed.
Yeah, well, hey, Josh, thanks for the question. I mean, it's a lot for investors to digest, right? The market doesn't even know what it's doing during the middle of the day. How are we going to decide about the next 6 to 12 months? It's very difficult. I mean, sentiment can be a powerful force on the upside, and when sentiment changes, it can be a very powerful force on the downside, too. And when we stack up some facts about the market, it makes sense that we're kind of going through squiggles right now. We've gone through 3 or 4 years of a super narrow market environment where only a handful of stocks are really outperforming the benchmarks. We've been overwhelmed with macro and thematics, AI, momentum, tariffs, whatever it is, thematic investing. And that's kind of getting tiresome. And then, market valuations. We specifically look at equity risk premium, which indicates the premium investors are willing to pay for stocks or equities versus a risk-free asset, and it's at the lowest it's been in a very long time. So we don't have much room to go on the upside of valuation. So it just feels like maybe a little volatility leads to lower stock prices, and that's just what's happening. I think we're just building some realism into some of these stocks and these thematics.
I guess where is the floor then, Brad? Because, at one point today, a lot of these large cap tech stocks were catching a bid, maybe on the thinking that they had pulled back enough and they were factoring in some of the bad news on tariffs and that maybe some of the, goods manufacturers would be hit harder. Is there anything to that? Do you think that that is a sort of legitimate way to look at it?
Yeah, thanks, Julie. It's really hard to call a floor. Like I mentioned, when you have sentiment turn, it's a very interesting dynamic. One of the things that we've done just to get a sense of the differing market environments through time, I think this may be instructive, is, we've looked at the frequency of certain market returns over time. And I think one of the things, this is kind of generational, right? If you look at how investors have experienced the market really since the start of quantitative easing, which was November 2008, that doesn't seem that long ago. What investors have really come to known, right, is I either get a good market or I get a great market, right? We've seen annualized returns over the last 10, 15 years that have been exceptional for market returns. And I think if you kind of rewind the tape and go back further in time, I think what you'll realize is once we get past easy money, once we get past, all this transfer of wealth from the government to the consumer and enterprises, it could be a much more challenging environment for investing. That's just the reality. The reality is we don't just have good markets or great markets. Some days we have resets and drawdowns, and those things occur. So I think it's very difficult for me to call the downside, but I think it is definitely possible that we see more downside, and that's why we say you got to find something unique in investing, and what we usually find is unique is quality. Stick with quality, companies that earn their valuations even through drawdowns.
And I'm just curious, when you say quality, Brad, how are you defining that? If you're screening for quality, how so?
Yeah, I mean, just pull out your Porter's Five Forces book, go to the library and study competitive moats and competitive advantages. That's where we spend the majority of our time. We're really looking for those businesses throughout our index that have something other people can't do, that offer critical infrastructure that others can't do. MSCI is an example of this. They obviously do the indices for that. A lot of products are judged against. We look at Intercontinental Exchange that runs the futures and options exchanges for energies and natural gas derivatives. Those exchanges are by default monopolies because you want to go where the most volume is. So that's what we're looking for. So regardless of where interest rates go or GDP lands or what we decide the valuation on the market can be, these companies are going to earn their wealth, earn their keep, and really distinguish themselves during these periods of volatility in the market.
And I guess what you would tell investors not to do is just sort of buy an index or say buy the Mag 7 or buy, these sort of collections of passive large cap growth, right?
Yeah, for sure. I mean, I think it's much more nuanced than that, right? I think there's different styles of investing for everyone, but I think what a message in the market should be now, and I hope I'm not doing like the more you know public service announcement. Anybody from the 80s would know that reference. But we call it blind concentration versus active concentration. And blind concentration, or being blindly concentrated, just means that you do own an index or you own a passive ETF strategy, and you're not digging in underneath the covers of that. And then all of a sudden you realize that what you think is a diversified group of stocks that you own is really 50% are in 10 names, which is where our benchmark is. Again, we have to be cognizant of that. And I think I just want investors to be aware, like, go investigate that. Be aware of really what you own. If you're in this myopic thematic of AI, but yet you think you're in a diversified strategy, might actually be very concentrated. So what we would argue is let your style manager be super concentrated. We have our product LRGG that owns 20 to 25 names in a very concentrated group of growth stocks, but we diversify across it. It's not just the AI thematic. And we think the empirical evidence is very clear. Not only can you get better returns over time by allowing your active manager to concentrate in their best names, but it doesn't come with a lot of risks. So we think there's a lot of benefits of being actively concentrated versus blindly concentrated.
Right. Brad, thanks so much. Good to see you.
Yeah, good to see you as well. Thanks.
Coming up, former NASA rocket scientist Aisha Bowe. She's one of the crew members gearing up for Blue Origin's next mission. She's going to join us on the other side. Stick around. Much more market domination overtime coming up. Let's get to CrowdStrike. That company's numbers just coming out in the past few moments here, and it's the forecast that is catching my attention. First quarter adjusted EPS, the company says, will be 64 to 66 cents. Analysts on average have been looking for 96 cents. The shares are down about 6% at the moment. This is after the company's fourth quarter results look pretty good here. Fourth quarter earnings per share, $1.06. That's above the $1.03, that's above the 86 cents that analysts had been anticipating. Fourth quarter revenue of $1.06 billion was also ahead of what analysts had been anticipating. And looking at the company's full year numbers of what it's expecting for 2026, fiscal 2026 here, adjusted earnings per share of at most $3.45. That's well below estimates. It does look like that the company's revenue is roughly in line with estimates.
Yeah, I will say, heading into the print, there were analysts who cover this one who were telling clients that this is a company they argue it's still working through the lingering impacts of that global IT incident over the summer, Julie. Though I also did see analysts heading into the printing were saying CrowdStrike should be facing easier comps ahead. Some commentary from the execs too. I see the CFO talking about achieving fourth quarter results above all guided metrics. Says they have confidence in their ability to achieve their target model by fiscal year 29, deliver long-term profitable growth. So trying to send a confident, optimistic tone here, but at least initially, investors are disappointed, it looks like.
And just one word about how the stock has done. It has recovered quite a bit since last summer, and the hack against CrowdStrike, so the shares are up about 24% over the past year. So coming into this report, they'd been fading that a little bit, but still higher over the 12-month period.
Down nearly 6% right now after hours. All right, Trump trade was dominating markets post-election, but now it's floundering. For more, we're going to bring in Yahoo Finance senior reporter Alexandra Canal. Allie.
Yeah, Josh, remember, it wasn't too long ago that stocks traded at consistent records following Trump's win, but the benchmark S&P 500 has now officially wiped away all of its post-election gains. The tech-heavy NASDAQ, that eliminated its election day gains on Monday, but also extended those declines today. In fact, we almost entered correction territory for the NASDAQ. For now, though, we were able to avoid that. But there are certain sectors of the Trump 2.0 trade that have just underperformed since November 5th. That sugar high that really invigorated markets to the end of 2024 and even to start 2025 just running out of steam. So I want to start with Treasury yields because this has been a significant move to the downside here. We are now trading at levels that we have not seen since the end of last year, right around 4.2%. At one point, analysts were saying that we could see up to 5% yields, especially when we were at some of these highs here earlier in the year. But as Citi analyst Stuart Kaiser noted, yields are not coming down for good news. They are pricing in, actually, that we're going to struggle when it comes to global growth, even as inflation remains elevated over the long term, and that the Fed is actually going to have to be forced to cut interest rates in order to preserve growth, preserve GDP, and that critical jobs market. So the Friday jobs report going to be especially important here. I also want to take a quick look at the U.S. dollar index. We saw a big surge in the dollar heading into the year. We're now off about 2% since Inauguration Day, so giving up some of those gains there. The dollar saw a pretty significant move to the upside due to that Republican sweep and, of course, Trump's tariffs. And then if we also take a look at Bitcoin, this was probably the biggest benefactor of the Trump 2.0 trade and the Trump election. We are still trading above what we saw on Election Day. Bitcoin was trading at around 69,000. We are significantly above that. However, we are below the critical $100,000 level that we saw earlier this year. Bitcoin is off about 22% since the record highs that we saw in mid-January. And at that point, Bitcoin was trading at around $109,000 a coin. Now, I also want to take a look at small caps because this is something that we really thought was going to surge due to Trump's deregulation policies, due to tax cuts, things like that. We have just not seen that. Small caps are down 8% since that November 5th close. And then if we take a look at some other sector action, we see sectors like energy and financials there underperforming. Financials actually have been the sole sector that has actually done pretty well since Trump 2.0. We're still at these highs. We are, of course, off a little bit what we saw earlier this year, but still financials outperforming, especially when we see different types of deregulation policies come out of the Trump administration. Of course, tariffs have been the priorities for now, but energy, industrials, that has really lagged. And again, a lot of this having to do with just the data that we've been getting, right? We've had softer data. We've had bad consumer confidence, bad consumer sentiment ratings, and that's leading to concerns again over growth in the U.S. in particular. And then you're seeing that rate cuts, markets are now pricing in 3 rate cuts this year. That's the first time that we've seen 3 at this point. And now we're seeing around 50% of traders think that in May we could see our first cut. That's up from 75% believing that we were going to remain on hold. So a lot to look forward to when we think about the different types of data that we will be receiving. But again, Friday's jobs report is going to be a crucial one there. Josh, Julie.
Thank you, Ali. Appreciate it. Well, Amazon Chair Jeff Bezos' space exploration company Blue Origin is gearing up for its next mission this spring. The company's new Shepard rocket will embark on its 11th human flight with an all-female flight team. That's a first for Blue Origin. Former NASA rocket scientist Aisha Bowe, she's one of the crew members, and she's joining us now to discuss. Aisha, it's great to see you. Congrats on your planned trip to space. I would ask, first of all, you are a former NASA rocket scientist, we mentioned. You're also the head of STEM Board, a company that you started, former engineer, and now entrepreneur. How did this come about that you are ending up on this crew to go to space?
It's always good to see you, Julie. You know, I feel like I've been preparing my entire life for this opportunity to have the option to be able to inspire and to conduct research at the same time is just the highlight of my career. As we know, in middle school, about 57% of girls decide that they don't want to pursue STEM fields because they don't see themselves reflected in these fields. Now with this crew, not only are we going to be able to inspire the next generation, but we're also blazing trail when it comes to being able to develop things like the next generation when it comes to microgravity research. And one of those experiments I'm actually going to be doing on my flight.
And what experiment is that going to be, Aisha?
Well, I'm excited to share that I'll be partnering with Winston-Salem University in order to explore an area of astrobiology. Specifically, we're looking at how plants respond to microgravity. Every second on the molecular level counts. And when we look at how plants respond to microgravity, this has implications on Earth when it comes to food security, as well as agriculture and sustainability.
So, Aisha, I want to come back to the original question a little bit, which is, you know, did you know some of the folks who were going on the trip? Did you, or is this something, I mean, I'm just going to come out and ask, do you pay to go on the space flight? How does this all work?
One of the things I'm really excited about my flight was I was able to work with partners in order to find the resources for my seat. And so through the experiments, through working with nonprofits, and through advocating for STEM education, which we've designed STEM lessons that go along with this flight, Julie, so that we can educate that emerging workforce, we were able to put together not only the resources to prove that if I can do it, others can do it too.
And Aisha, how do you get selected for an adventure like this? What is the process?
Well, I think that's evolving. One of the things that's unique about my mission is that the individual who I was brought into the crew by was someone who I met my first day of work at NASA. Her name is Nancy Conrad, and Nancy, for a long time, had education activities that were centered at NASA Ames through the Conrad Foundation, where they were encouraging students to pursue STEM fields, much like what I do now today. Through her advocacy and mentorship, not only was I introduced and ultimately vetted for a role in the crew, but I was also able to do something that I'm really proud to be able to share with the world, which is I'm returning the Apollo 12 flag back to space. And so one of the other things that I'm going to carry, thanks to the Museum of Flight in Seattle with me, is a powerful symbol of the past, the future, and the present of space, which is individuals who have maybe non-traditional origins for getting an opportunity to go to space.
Aisha, as somebody who formerly worked at NASA, who now works in the private sector, and now he's going to space as part of the private sector. I'm really interested to hear your perspective on the role that each of the public and private sector plays in the space race here. Is it something that you think is not going to be as much a part of the, sort of federal move, and it will be more taken over by the private sector?
I mean, I think that the move in order to empower the private sector to play a powerful role in space is genius. What we've seen over the last decade are commercial spaceflight companies leading. In 2023, the commercial spaceflight industry, specifically satellites, right, just alone generated about $384 billion. Part of this would not have been possible had the decision not been made to help enable SpaceX and Blue Origin to be the organizations that they are today. And so what I see in the future is an industry that not only is growing into a $1 trillion opportunity, but a workforce out there that we can inspire, we can empower, and we can enable to take advantage of this growing market opportunity.
Aisha, great to have you on the show today, and have fun on that flight. Flutter Entertainment fourth quarter earnings, they're crossing the wire moments ago. And here to help us break it down is Yahoo Finance's very own markets reporter, Josh Schaefer. Josh.
Hey, Josh, so Flutter stock's been bouncing around a little bit after results. So Flutter, of course, the parent company of popular sportsbook in the U.S., FanDuel. So we're going to take a focus on their U.S. business, but I'll go broad first with just the results for the quarter. So for the fourth quarter, Flutter reported adjusted earnings per share of $2.94 on revenue of $3.79 billion. You can see on your screen there, revenue slightly lower than Wall Street had hoped for, but adjusted EPS coming in significantly higher than analysts had projected. Now, their guidance for 2025, about in line with what Wall Street had expected. So they issued guidance for their U.S. business for the full year, looking at revenue in a range of $7.47 billion to $7.97 billion. Again, that was about in line with the median estimate from analysts at $7.69 billion. I did speak with Flutter CEO Peter Jackson. He said one of the keys right now for them is they did have a strong Super Bowl. They had a positive outcome for that Super Bowl. A couple interesting stats that stuck out to me about betting for the Super Bowl. FanDuel saw around 17,000 bets per minute at peak level engagements during the Super Bowl, and they saw almost $500 million of wages for that Super Bowl betting, so they're hoping that's going to carry into more of 2025. One interesting thing that I did ask Peter, Josh, was I asked him about the consumer slowdown story, right? We keep hearing from these different companies exposed to consumers, there might be a little bit less spending happening in 2025. Interesting that Peter Jackson points out that hasn't really been the case in terms of gambling. He said it did not impact how they're thinking about their guidance in 2025. They go back and they look at prior periods of economic slowdowns. He said even the great financial crisis, when they were only operating in Europe and there was recession over there, they just don't see spending slow down for people that are gambling. People cut down on other things first. They cut down on other things at the store.
Not placing a bet.
But it does not cut down on their wagers that they're placing. So that's not really part of the story in terms of what's happening in the gambling space.
It's so interesting. Thanks, Josh. Appreciate it. Time now for what to watch. Wednesday, March 5th. We're going to start off on the earnings front. Another round of earnings coming in tomorrow from Campbell's, Abercrombie & Fitch, and Marvell, among others. Abercrombie & Fitch announcing results for their fourth quarter before the opening bell. Analysts expecting the company's sales to surpass estimates for the fourth quarter, driven by revenue gains from its Hollister brand.
Taking a look at the labor market, we'll be getting some fresh jobs data from in the morning with ADP employment. Economists forecast the private sector added 140,000 jobs in February. That would mark a slowdown from January's report.
And moving over to housing, weekly mortgage rate application data that's coming out in the morning. The latest data showing applications decreasing 1.2% from 1 week earlier, marking a second straight week of declines.
But before all of that, President Donald Trump is addressing a joint session of Congress tonight. That marks the first major speech of his second term. He's expected to address a wide range of topics, from today's tariffs taking effect to the conflict in Ukraine. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Ask Me For a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.